Welcome back, Sandeep. How was your break?
Oh, it was wonderful. Thankfully, the market also did move in line with what we were expecting. Well, not the speed, of course, but the fact that, we had been saying for some time that we would be biased between 44 to 4,600. And of course, as symptomatic that at 44, 4,600 we couldn't find any bulls, I think now the bears are getting to be a fast extincting species as we've rallied about 1,000 points. I think that broadly, what started off as a liquidity-driven relief rally, in the US relief that economic data was better, in the US, in Eurozone that the liquidity pumping by the ECB had pushed away the solvency issues, and in India actually relief that the third quarter results were not as bad, and that the government might also be moving. I think it's moving away from being a relief rally to a rally where actually there are a fair amount of expectations now getting built into the price. And so to that extent, the momentum can take us much higher, quite possibly. But I think it's no longer the zone where we are aggressively buying stocks. I think it's a zone where you either stay invested or at higher levels you may look to buy some protection.
The constant feature of this rally has been infra and banking. Now, banking stocks and infra stocks were beaten down in the month of November and December. They are bouncing back. That's valid. But fundamentally, the landscape has not changed for either banking or for infra. So at these levels, would you say it's time to log out of banking and infra?
Well, I think I would actually differentiate the two sectors because at least as far as banking is concerned, it's clear that NPAs, though they've risen last quarter, they haven't really risen at a terrible pace, at a pace at which the market was actually fearing. And there are these exceptions, there are banks by exception. I presume we are discussing the public sector because if you look at the large private sector banks, there's no concern about NPAs. The concern about NPAs is really on the old generation private sector banks as well as the public sector banks. I think in the public sector banks also, I think one can find a few banks where the concern of NPAs is perhaps lower. So where banks have shown a resilience and been able to manage the NPA cycle, I think those banks one could stay invested because the valuations are still in your favor. However, banks where actually NPAs continue to rise at an alarming pace, I think it's a good time to log out. I fully agree with you on that. As far as infra is concerned, I think it's a little more complex in the sense that I fully agree with you that fundamentals haven't really changed. These companies are still straddled with debt, the order books are still not growing, but there is hope in the air and there is optimism in the air. So I think that infra is perhaps a sector where you may want to actually trim some of your gains because simply from a concern that what if the government doesn't deliver. And I think in terms of investing, I would like to follow the more conservative principles. That is, the first principle of investing is conservation of capital, and after that is consistent profitability and superior returns. So from that perspective, it might perhaps be safer to get into some of these infra stocks once the landscape is clear. You could argue that you might miss out another maybe 40-50% of the move, but then you're sure that your capital is safe. So yes, infra selectively, at least or partially, I think one could look to book profits.
What is fueling rally and momentum in auto stocks? Because if I check on commentary which is coming from most of the auto companies, the commentary is the base effect has kicked in, interest rates are still high, and margins will impact their profitability for the coming quarter. But if I check on auto stocks, Maruti, Tata Motors, Bajaj Auto, Hero MotoCorp, excepting Mahindra and Mahindra, everything is up.
Well, I think typically at the top of the interest rate cycle, I mean, if there are two sectors you want to buy, it's obviously banks and autos. So however, autos, this has been a slightly different kind of, if you look at last year, it was a slightly different kind of bear market where typically what you tend to see is that the commercial vehicles actually sales fall off the first, and then you see, cars and then two-wheelers. But this time around, commercial vehicle sales held up very strongly, even in all of last year, partly because of, semi-urban and rural demand. And that's actually the reason why M&M actually, which outperformed earlier on, is therefore now underperforming. So I don't think you want to chase them because, as you rightly mentioned, the fundamentals still need to, fall into place. But one is willing to buy a little early in these sectors because, there isn't any issue of government intervention, of approvals, of, getting coal linkages, and all of those issues are not there in auto. So it's a far cleaner and a crisper story, and you can actually take a clear call on what's happening to the sector based on the volume numbers which are disclosed every month. So from that perspective, I think it would make sense to stay invested in autos. But yes, certainly not chase the momentum because, as you rightly mentioned, a lot of the factors need to fall into place, which will hopefully happen over time.
So for those who are planning to buy banking stocks now, Sandeep, are they buying slightly, behind the curve? Are they late in that rate?
Well, I think if the government delivers, if we have low fiscal deficit, if we have reform, and the Samajwadi Party comes and supports the government at the center, and if everything is right, and there are blue skies everywhere, then you might not be late at all. But I think there's a risk to all of that. So prudent investing would suggest that you should be careful at current levels and not chase stocks here, because they've already run up. Some of them have run up between 30, 40, 50%. So you don't want to ride the momentum, and if you have to buy something, then you'd rather buy something that's a little safer, where even if things go wrong, you know that you will get your capital back in the next, whenever the markets turn once again, and the sector turns once again for the positive. So if you have to invest in banking stocks now, buy the bigger, safer ones at this stage.
Just want to get your thoughts on a couple of these divestment candidates. We've heard that it's the auction process which is being selected for ONGC. Do you think come FY13 and we may actually see heightened activity and thereby auction processes may be selected for the likes of NTPC, even a Coal India and BHEL in any case which is in the pipeline?
Well, I'm not an investment banker, but I think one of the reasons why the government seems to have chosen the auction process is also that you don't have to declare a price unless they declare a reserve price here. And but markets have changed, right? Last year, any disinvestment announcement and stocks would fall 10, 20, 30%. And here we've had an announcement of ONGC and BHEL disinvestment. ONGC's, of course, I think one would argue there's relative value, but there is no clarity on the upside because you don't know what percentage subsidies they'll have to pay for. BHEL, on the other hand, is clearly a stock where order inflows have been down 60% for the last 9 months, and still the stock goes up on the announcement. So I think the government may well continue to choose auction as a method, but I think the rationale for choosing it was to actually avoid having to cut the time frame for actually disinvesting, having to announce a price band where traders would actually try and take advantage of. I think none of those factors seem to exist at this stage. That could change going forward. But yes, I think the short answer to your question is I think auction is a far cleaner, quicker process, and to that extent I think it's welcome.